Students, so today we will talk about the accounts and balance sheets. Okay, so we have here in accounting records are all of the documentations and books involved in the preparation of financial statements or records relevant to audits and financial reviews. Accounting records include records of assets and liabilities, monetary transactions, ledgers, journals, and any supporting documents such as checks and invoices. So we have here the T account. So a T account is an informal term for a set of financial records that uses double entry bookkeeping. The term describes the appearance of the bookkeeping entries. First, a large letter T is drawn on a page. The title of the account is then entered just above the top horizontal line. While underneath, debits are listed on the left and the credits are recorded on the right, separated by the vertical line of the letter T. Okay? So you already know about this, the debit and credit sides. So also T account is called a ledger account. So do you just remember that T account is also called ledger account? In understanding a T account, in double entry bookkeeping, a widespread accounting method, all financial transactions are considered to affect at least two of a company's account. Okay, so it is minimum of two a company's account. Chart of accounts. One account will get a debit entry while the second will get a credit entry to record each transaction that occurs. The credits and debits are recorded in a general ledger, where all account balances must match. The visual appearance of the ledger journal of individual accounts resembles a T shape. Hence, why a ledger account is also called a T account. So a T account is also a graphical representation of a general ledger that records a business transactions. So it already told you that it consists of account title, debit in the left, and credit in the right. Always remember that T account has account title sa taas, then debit side on the left, and credit side on the right. Okay? So a T account is an informal term for a set of financial records that use double entry bookkeeping. It is called a T account because the bookkeeping entries are laid out in a way that resembles a T shape. The account title appears just above the T. Underneath, debits are listed on the left and credits are recorded on the right. So, how do we record the T accounts? So, for different accounts, debits and credits may translate to increases or decreases. But the debit side must always lie to the left of the T outline, and the credit entries must be recorded on the right side. So, the major components of the balance sheet is assets, liabilities, and shareholders' equity. So can be reflected in a T account after any financial transaction occurs. So in a balance sheet, it is composed of assets, liabilities, and shareholders' equity. So T accounts also have advantages. So T accounts are commonly used to prepare adjusting entries. So the matching principles in accrual accounting states that all expenses must match with revenues generated during the period. So the T accounts guides accountants on what to enter in a ledger to get an adjusting balance so that revenues equals expenses. So we have here the guide to accounts that adjusting balance in revenues is equal expenses. What is that revenues? It is the income, then equals to expenses. So a business owner can also use the accounts to extract information, such as the nature of a transaction that occurred on a particular day for the balance and movements of each account. An adjusting journal entry is an entry in a company's general ledger that occurs at the end of an accounting period to record any unrecognized income or expenses for the period. When a transaction started in one accounting period and ended in a later period, an adjusting journal entry is required to properly account of the transaction. Adjusting journal entries can also refer to financial reporting that corrects a mistakes made previously in the accounting period. So we will move on to a balance sheet. So what is a balance sheet? So a balance sheet provides a picture of a company's asset and liabilities, as well as the amount owned by shareholders. A balance sheet can help you determine what a business is really worth. When reviewed with other accounting records and disclosures, it can warn of many potential problems and help you to make sound investment decisions. So we have here the role of balance sheet. So for every business, there are 3 important financial statements you should examine. So we have here the balance sheet, income statement, and the cash flow statement. So in balance sheet, investors how much money a company or institution has. So ano ba yung meron sa company? We have assets, liabilities, and shareholders' equity. Okay, so the income statement, ano ba yung mga income statement ng company? So ito yung record of the company's profitability na sinasabi sa iyo kung magkano yung pera na ginawa ng company and yung nawala sa company. Also, the third one is the cash flow statement. It's a record of the actual changes in cash to the income statement. Ano ba yung nagbago sa cash flow ng inyong company? So, it shows you where the cash was brought in and where the cash was dispersed. So, kung ano yung pumasok na pera, ano ba yung pinagamitan ng pera? So, paano ba basahin ang balance sheet? So, in a balance sheet is composed of rows and columns that list a company's assets and liabilities and money owned by shareholders. Okay, so one column lists the category of assets and liabilities, and one lists the total amount for each of those categories. So it may even have 2 years worth of information. Oftentimes, assets are listed in order of how quickly they will be converted into cash, and liabilities are listed in order of their due dates. Sometimes shareholders' equity follows the assets and liabilities on the sheet. You may want to look at the company's balance sheet to determine its financial health. Okay? So, kaya meron tayong balance sheet para makita yung financial health ng ating company. So, ideally, a company's assets should be equal to its liabilities and shareholders' equity. So, you can determine by analyzing a company's financial information by this. Okay, so we have here you can determine how much debt the business has relative to its equity. You can determine how quickly customers are paying their bills. You can determine whether short-term cash is declining or increasing. You can also determine the percentage of assets that are tangible and how much comes from accounting transactions, whether products are being returned at higher than average historical rates, how many days it takes on average to sell the inventory the business keeps on hand, whether the research and development budget is producing good results, whether the interest coverage ratio on the bonds is declining, the average interest rate a company is paying on its debt, where profits are being spent or reinvested. So we also will know the measure of financial strength and liquidity. The following ratios act as measures of company's financial strength and liquidity. Liquidity measures such as working capital and quick ratios help you evaluate a company's ability to pay off its current debt obligations without having to raise any external capital. So this information will help investors determine a company's intrinsic value and margin of safety. So here are some keys, ratios, and calculations used to determine financial strength. So we have the current assets, current liabilities. So in working capital, you must subtract the current assets and current liabilities. In working capital per dollar of sales, working capital over total sales. Current ratio is current assets over current liabilities. Quick ratio, current assets minus inventory over current liabilities. And debt to equity ratio, total liabilities over shareholders' equity. So these are some ratios and for calculations used to determine financial strength. So you must know also, and you must memorize these formulas and understand it well. So also you can test a company efficiency. So we have here the receivable turnover ratio, net credit sales over average account receivables. And average age of receivables is equals to numbers of days in period over receivable turnover. Inventory turnover is equals to cost of goods sold and average inventory. Number of days for inventory to turn is equals to number of days in period over inventory turnover. So I have here the example of a balance sheet. So we have here the assets, liabilities, stockholders' equity. Okay, so how you will get the assets count? So here the total assets. So in our formula, total liabilities plus the total stockholders' equity is equal to total assets. So every time in our balance sheet, you must determine and equal the left or right side. Okay. So that is for today. You just comment down below for more upcoming videos and learn how to use the bookkeeping lectures, how to be part of my class bookkeeping. So always subscribe also in our channel so that you can be updated in our studies. So